Welcome guys. Welcome. This is part 2 of the residual FX profit forex education. You can earn guaranteed income, passive income from forex without tears, even as a beginner. So today, in this section, we are going to be discussing the basics and the fundamentals of forex trading. My goal for you is to understand the very basics of forex and the fundamentals. Now, before we continue, let us see some guidelines that you need to adhere to as you are starting your forex trading career. Rules number 1 is that you should never place your life savings in forex. What this means is, if all you have at the moment is 100,000 naira, I'm saying that you should not take this entire 100,000 naira and put it in forex. No. But let's say if you want to start with forex trading and you have 100,000 naira as your entire savings, you can divide that sum of money by 3 and take one part of it to invest in forex trading. So it is very, very wrong to place your entire savings in forex, because if you do that, what will happen is you will be on pressure. Yes, you will be pressured most of the time when you are trading, and that would lead to you making and taking wrong decisions, and these decisions will make you lose your entire trading capital. So because you do not want to be pressured while you are on trades, you want to be trading with a good mindset, you should avoid placing your entire life savings in forex. Now again, I also want you to note that as you are starting the forex trading career, please do not quit your job. Do not quit your business simply because you want to start forex, and you know forex is over $5.7 trillion, and you want to be making a lot of money from the forex market. Do not quit your job, because at the end of the day, you need money to invest in your trading capital. You need money to invest in your trading education, your forex education. You also need money to invest sometimes in the right tools. So this money should come from somewhere, and not you trying to trade this money hard. No. So you should keep your job, keep your business, and then you could take money from your job or your business and then fund your forex journey, fund your accounts, fund your education, and even fund your tools. By doing so, within the next 1 to 3 months, you should be trading forex profitably and without you having any issues. Now, rules number 2 is that according to the rule of correspondence, as within, so without, likewise in every win in forex, there must be a corresponding loss. Now what this means is that do not expect that as you are starting your trading, even if you are using the best tools, you got a VIP trading from the best trader in the world, do not expect that you're never going to ever lose in the forex market. Yes, you're going to have some losing trade. For you to win, there must be a corresponding loss. But when you have proper risk management in place, that should be able to mitigate the loss as against your win. So even though you are losing, at the end of the day, you're also making profits. And when you check your overall trade for that day, you find out that you are on a profitable day. When you check for the week is profitable. And when you check for the month is profitable. But when you go through your trading history, you will always see some losses together with your wins. Now, rule number 3 is never give money to somebody or someone to trade for you. It's just like you sending somebody to go to school for you. Why not you go to school yourself? Now, there are things you are going to miss in this industry that you are coming into, and I want you not to fall prey. Do not fall for them. Number one, scammers. People who are there to scam you of your hard-earned money. Now, what they will tell you is that they will trade for you. They will trade for you. Don't give them your money. That once you just send the money to them, that is all. They will never even invest that money into forex. They will just go squander your money, and that is it. Again, there are some scammers who are out there who may look legitimate. They are there with a website called this HYP websites. They are investment websites. They tell you, they give you a percentage of return. So invest this amount of money, will give you 1% daily. Some will say 5% daily. And then when you invest your money at the end of the month, you're going to get back your capital. Sometimes, while some may be paying, at the end of the day or the end of the month, they may end up crashing the system. Sometimes some of this system will pay people to be able to get much more people, that when they are closing the system, they're going to be closing with a lot of money. So do not fall for these people. They are just pure scam. HYP, highly yield investment program. They will tell you we trade for people. What we do is we invest your money. We are into forex trading. We are into Bitcoin trading. They are not real. So what is best for you to do is learn forex yourself and trade yourself. You're also going to meet people who will tell you that they are account managers. Yes, they are account managers. Sometimes these are well-meaning people. Yes, they mean well for you. They even mean well for themselves. They will tell you they can help you trade. Now, with the mind of, if they make profits for you, you are going to give them a share, a percentage of your trading, of your profits. But at the end of the day, when you give those people your account to trade for you, they will end up blowing your accounts. So no matter how a person might brown this or herself, do not agree. Do not agree. Learn forex trading yourself. Do what it takes for you to be profitable and start trading yourself. So do not allow people to take money from you or take your account details from you and start trading. They will just end up losing your money. Now, rules number 4 is never rely on one source of information. Rather, you need to gather as many information on forex as you can from different sources. And as you gather this information, you need to sieve this information. Some of them may not fit your lifestyle or fit your trading style. Sieve this information and take only the ones you need. Now, I'm telling you that as you are learning forex through ResidualFxProfit, you should not depend only on our educational course. You can go out there and get courses from other people. You understand what I mean? Learn from other people. You can get other mentors from other places. So that is what we mean. Never rely on one source of information. Now, let's go into an introduction to forex properly. Now, what is forex? Forex is an acronym for foreign exchange. So what this means is that from foreign, the word FOR was taken. Then from exchange, the first word EOX was taken. That is FOREX, forex. That is it. So when we're talking about forex, we're talking about foreign exchange. Now, the forex market is the process in which a nation's currency is traded for another at a mutually agreed rate. Now, the forex market can also be seen as a global market that allows one to trade two currencies against each other. Now, I want you to know that the forex marketplace encompasses of different set of people, wide range of different market actors. We have the world's largest financial institutions, and these people, they deal with money transactions, large money transactions. We also have the small banks. We also have ordinary people who are converting few dollars. Some are here in Nigeria, some are outside around the country. We also have retail traders like you that's going into trading now. So the forex market, we have a lot of people, a lot of actors who are trading these markets. So it's not just you or people using their phone to trade. No, not just people trading with their phone. So the people in forex market is very, very diverse. Now I want us to see a case study of how someone can trade forex, and that is, you imagine somebody traveling from one country to another, let's say from UK to US, and then when they finally arrive in US, what you find them do is that they go look for an exchange booth at the airport, and then they go when they see an exchange booth, they take all the money from their wallets and try to exchange the money in their wallet to the money of the currency of the country that they just landed. So for this case now, you left UK and you have some pounds in your wallet, you have to change those pounds to dollars. Now, when you get to the booth, you're going to see a counter, and you're going to notice when you get to the counter, the booth, wherever, you're going to notice a screen that is displaying different exchange rates of different currencies. So you're going to look at them, and you're going to know how much your money will be worth when you have exchanged it. So what we mean by exchange rate is that exchange rate is the relative price of two currencies from two different countries. So maybe when you check your wallet, you find out that you have over 10 pounds. 10 pounds in your wallet. Now when you check at the screen, you find out that a pound is worth $300. What does that mean? It means your 10 pounds will give you about $3,000. And you say, wow, I'm rich. Yes, because initially what you were having is just 10 pounds. It may look small, but when you've done the exchange, you're now having over $3,000. Now, what you simply did is that you have participated in forex. That is how people participate in forex, sometimes even without knowing. So in one way or the other, you must have involved yourself in forex. Just that some of us, we don't make profits while we do or trade forex without knowing. Now, what are the benefits of trading forex? Now, one of the benefits is that forex market is 24 hours per day. It is open. The market is open 24 hours per day, and throughout the week is open Monday to Friday, which is 245. Now this gives you flexibility to trade anytime within these 24 hours a day and 5 days a week. So that does not mean that you have to be on the market from morning to night for 5 days. No, you're not on the market. So within this day, within 24 hours in a day, you can just pick one of the hour, enter the market. You can close the market, close the trade within the next 2 or 3 hours. That is all. So you have flexibility. Again, for those who will be trading with other brokers, they're going to be trading 247. I'm going to talk about it later. Now, you can also build your business from anywhere that you are in the world. If you are in Nigeria, even if you are in a very deep village, so long you are connected to network, you can be making money from forex. Yes, and you can build your forex business from anywhere that you are in the world. Now, you can also plan your daily trading routine around your day job. That is to say, if you have an existing day job or a business, you don't have to quit your business or your job before you can trade forex successfully. All you have to do is plan your daily trading routine. You know when you want to trade, whether before you go to work or after you're done, when you're back home, or maybe you want to pick the trade in the morning before you leave, and then you're looking at closing the trade within your work hour or when you're back. So you have the time, the ability to plan your trading routine around your job. Also, with trading forex, you're going to be generating consistent and regular income. And again, you should be making over 5% to 20% profits of your capital every single month. And sometimes, depending on your trading tools and your account, you can be making 50% profit per month. And this is very possible. Like I said, for those people who are trading with derivative traders, they enjoy trading the market 247. That is to say, even on weekends, Saturday and Sunday, derivative traders are also making money. Why forex traders are going to be waiting from Saturday and Sunday? They can't trade, they can't make money Saturday and Sunday. They have to wait till Monday morning before they start making money again. Those derivative traders are making money Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and Sunday. So if you don't know about derivative, you can chat me up. I'm going to show you derivative and how you can become a derivative trader making money from the market Monday to Sunday. Now, the biggest benefit that I see when it comes to forex trading is that you can make a guaranteed income from forex even after you have retired. Maybe you are fired from your job, or maybe you never even had a job in life. Maybe you just finished your secondary school or your university, and then there is no job. You've been looking for a job, no job yet. You can dive into forex and start making money from forex. Or maybe you have a business, but your business is bad. You can also be making a guaranteed income, a second income from forex. Even if you lose your business, you know that you can always depend on forex. Again, another benefit of forex that I see is that you can trade forex with your smartphone or just your laptop. That is all you need. That is all you need from anywhere you are in the world. All you need is your laptop or your smartphone. And you also need an internet connection. Internet connection is very, very important. And if possible, if you want to be trading forex, you want to look for the best network within your area and start using that network. And again, the last thing you need for forex, remember, the first thing you need to trade forex is a laptop or a smartphone. The second thing is an internet connection, and the third thing is the requisite skill. The skill or the tool, the right tools. You need the right tool to be able to trade forex because you want to be trading profitably. So these are all you need, unlike any other business out there that you need so much to start. In forex, this is just 3 things you need to start making money from forex. Now let's go over to understanding some basic forex terminologies. Now the first thing we're going to work with is buy. What is buy when it comes to forex? Now let's say there is gold, and 1 ounce of gold is over $1,500. Now you might think that the price of gold is going to increase. Now the moment you have that thought and you confirm that your thoughts through maybe technical or fundamental analysis, in forex what you need to do is you are going to open a buy trade in your trading platform. So all you have to do is go over to your MT4, your MT5, open it, and then take a buy trade on gold. We also call these long. You are longing for the trade for gold. Now what this means is that you open a trade at that price 1,500. When gold was 1,500, you open a buy trade. Now what you are expecting now, because your speculation is that the price of gold is going to go up. So your expectation right now is that since you have opened your trade, price of gold should go up. Now once price of gold went up, actually you're going to be making profits. from the difference between your buy price and the sell price when you close a trade. Now let's say you open the gold, you open a buy trade when gold was $1,500, and then price keep going up, and then you close the trade when the price of gold hits 1,525. What that means is you have made $25 profits. Although this is just a simple way of making you to understand, but there is more to it when you want to calculate your profit. But that just how it works. Now, if you look at the picture in the screen now, you see that if this is gold, this is a chart for gold. At this point when price was $1,500, let's say you take a buy trade, you bought gold at these points, Now what happens is we see price shooting up, comes down, up, comes down, up, comes down, and then went up to this point. If at this point is the price of gold at this point is 2,200, and then you close the trade at that point, or some of you might want to say you sell back the trade. You know, you bought gold here, now you sell back the gold at this point. The profit you're going to be making is the difference between 1,500 and 2,220. That should be over $700 profits. So you see, that is how forex simply goes. That's how you trade forex. Now, again, you're buying a currency with the expectation that the value of the currency will increase and you make profit in the difference between the purchase and the sell price. Now let's take a look at this. Let's say this is gold. Well, we want to long for gold, we want to buy gold. Now this is gold. This is where the price of gold is currently. This blue line you're seeing here, that is where the price of gold is currently. Now this is where you make your decision. Gold will go up, I want to buy now, and then you buy at that point, and eventually the price of gold is going up. Remember, you've bought, the price of gold is going up, it's going up, it's going up. What can you see here? It means you are making profits. But if at the time that you place a buy order at this point, the price of gold, remember you place a buy order, the price of gold now begins to come down, What is happening to you? You are losing. That is how forex work. Now, take a look at this again. You see this? You buy at these points. Now, when the price comes down, you're losing. So let's say this is two different persons. This is me, and this is you. This is what you are doing, and this is what I'm doing. Let's say at the same point, at this point, you are buying, and me, I'm selling. Sorry, I am buying, and you are buying. I am buying, and you are buying. You understand the point? I bought, you bought. Now, when I bought, the price is falling. But when you bought, the price continued to go up. What happened? You make a profit of $40, while me, I'm losing $40. You understand the point? Because my speculation was wrong. Now, I want you to know that in forex trading, you can long and you can short. Although this is in opposition to the traditional investing. You know, in traditional investing, you only make profits when the market is going up. Yes, that is when you make profits. Now, in traditional investing, if the market is crashing or the market is going down, if one of your assets has a downturn, it means that will automatically have a negative impact on your investments as a whole. So if you made an investment and the market is crashing, it means you are losing money and you cannot make money from that. That is how it is in traditional investing. But with Forex, whether the market is going up, you are making money. If the market is crashing, you can also make profits as well. So we are making money from both rising and fall. So Forex is the trading of rise and fall of different currencies, and you make profits doing so. Now let's take a look at sell, how you can make money from sell. Now, if for example we're still working with the price of gold, the price of gold at 1 ounce is $1,500, and then you speculate. You saw beforehand that gold is going to fall down. What do you do as a good trader? Instead of buying gold, you sell gold. So if you sell gold at $1,500, if you sell gold at $1,500 and then gold falls down to $1,450, gold was $1,500. It was supposed to go up, but we see that the market is now going down, the market is falling, and then we sell at that point, and then it falls down to this point, and then we close the trade. Some of us might say we close the trade. Some people will say we buy back. You understand? So whatever the case, you close the trade at 1,450. The difference between 1,500 and 1,450 is your profit, and that is about $50 profit. Now let's continue. This is it. For example, this is gold, and we are shorting gold. When gold was $2,000, we saw that gold was going to fall. As a wise investor, what you do is you buy gold at that point. You sell gold at that point. You sell gold at that point. Instead of buying gold, you sell gold. And when you sell gold to this extent, now gold fell down to 1,200, you can buy back, or you close your trade. You close your trade. When you close your trade at this point, you are making a profit of $800, which is the difference between $2,000 and $1,200. Now, I don't want you to get yourself confused when we talk about buy and sell when it comes to Forex. We're talking about gold right now. The fact that you are buying gold, if you are going for a buy trade, the fact that you are buying gold does not mean that a Forex company or Forex broker will send gold to your address, send you some gold to your address. No. Nor will they send some gold or artificial gold to your trading account. No. This is just how it plays. So that is it. Now, remember, for you to short is to sell a currency with the expectation that the value of that currency will decrease, and you buy back at a lower value, benefiting from the difference. Now let's take a look at this. Now we're talking about selling. This is sell. We're selling gold at this point. Gold. Now let's say this is the point where we see gold. Let's say we wake up this morning and we see gold at that point. You have two decisions to make. Do I think gold will go up or gold will sell? If you want to take a trade, you do your analysis, proper analysis, either fundamental, technical analysis, and then make the decision. If you say, gold is going to fall, I'm going to sell gold, and then you sell gold. If gold is actually falling, true, you are going to have what? You're going to be on profits. But on the other hand, if you decide that gold is going to fall, I'm going to sell gold, and then you sell gold at these blue points. But when you look at the market, what is playing on the market? Gold is rising. Gold is rising. Gold is going up. What do you think is happening to you? You are losing money. Speculation. That is what Forex is all about. So, in a long Forex trade, the trader would think that the value of the assets will increase So they will open a buy trade at a lower price. You buy at a lower price at this point. You see, these are the low. You buy at this point, and then you close the trade when the trade has increased to a higher price, for you to make the profits between the difference between this point and this point. But if the market turns against you, you'll be on loss. You'll be on loss. There's something I'm going to talk to you about in the practical session. When you're making profit, you buy, you're making profit, and it gets to this point, and then maybe you did not close the trade on this point. If the market start coming down, the profit will be reducing, and if it even gets down again, you're going to lose your profit that you've made since you've not closed the profit. We're going to talk about this in the practical session. Now, again, when it comes to a short forex trade, the trader thinks that the assets will decrease. Therefore, the trader will open a sell trade and close that trade at a lower price, and then you're going to make profit. So if you think that the trade will the price for gold will fall, you sell when the price is high. This is it, gold at this point, so you have to wait. You think it's going to fall, you have to wait for the price to go high a little, and then you take a sell trade at that point, and then when it's coming down, you are making profit, and then you close at the points, and your closing points must be lower than your entry points if you're taking a sell trade, for you to make profits. Now, there are some terminologies I want you to understand when it comes to forex. When we talk about buy, the number one, it means the same thing as long. So if somebody is telling you I long gold, what the person simply means is I bought gold. The same thing is also as bear. Some people will tell you this is a bear market. This is a bear market. Oh, sorry. A little bit of each here. There's a little error here. Now, this should be bull. Pardon me. Okay. This is bull. Yes, bull. So when I say this is a bull market, it means the market is a upward market. It's an upward market. Therefore, for you to make profits, you buy. Now, when people say the market is the bearish market, it means the market is a market that is falling, that is crashing, and the best way to make money is to sell. The same way as puts. Some people will call it puts. These are mostly when people are trading binary options, call and put. So when you say call, it means the person also bought. When you say put, it means the person also sold. That is it. So remember, sell, short, and bear are all the same thing. They are meaning, or they are working together with puts. Then when it comes to this side, we have buy, long, bull, and call. They work together. That is why you see in your picture we have the bull at the side and we have the bear at the side. Now let's move over to what is called PIP in forex, because these are little things we're going to be talking about later in future training. We're going to be using these to calculate our profits and a lot of things. So pips is, when we talk about pip, it means the base unit of the price of the currency pair, or 0.0001 of the quoted price, especially in a non-JPY currency pair. Now what this means is that when you see a price on the market quotes, the market watch, now the pip there is this. This is the pip. Usually it is for the digit after the fourth digit after the decimal point. The fourth digits after the decimal point. So this is decimal point, digit 1, digit 2, digit 3, and digit 4. the fourth digit after the decimal point, that is a pip. So if this is a price, the pip there is 8 pips. 8 pips. You understand the point? Now this 8 you are seeing here is the base units. It's a base unit. You understand the point? That is why if you look at this diagram here, you see that we have 1.149, then 8 is on blue. That 8 is the fourth digit, and that is the pip. The same applies here. 9 is on blue and is the pip. It's the fourth digit after the decimal points. You understand? Now, when you want to calculate pips, is, for example, you look at this. This is price, and this is the same price, but this one is 9 and this one is 8. When you look at the pip, now the difference between 8 and 9 is 1. So we're saying that this is 1 pip. 1 pip. We use this in calculating. Now, for example, let's say price of gold was at, let's not use what we've been using, $1,500. Let's say price of gold was at 1.6667, and then price of gold went up to 1.6687. Now, how many pip movement did we experience? We're going to make plus and minus. Now we're going to minus this from this. Now when we are doing the minus, remember we are talking about 1, 2, 3, 4th, the fourth digit after the decimal point. So we're not going to be working with this 7 that is here. We're going to be working with 7 and 8. So 7 minus 8, or this entire value minus this entire value where price is now. So what we're going to get is 1. So what we have there is 1 pip. 1 pip movement. 1 pip. So that is it. That is what pip is. So we use pip when we want to calculate the profit make, how much profit we have made from the market. We're going to use pip together with the lot size that we took the trade. You understand, the pip and the lot size and some other values to calculate our profit, which we're going to discuss much more later. Now we have what is called spread. Now the spread is the difference between the purchase price and the sales price of any currency pair. Now most popular currency pair, the spread is very low. Even sometimes it has the spread is even less than the pip. While for currency pairs that is not traded most times, the spread is higher. Now for a forex trader to become profitable, the value of the currency pair must exceed the pip. The value of the currency pair must exceed the spread. We're going to understand this later. Let's continue. Now, in forex, the spread is the difference between the purchase price and the sales price. So this is a purchase price and this is the ask price. We see it as bid and ask. So the difference is the spread. That is why we see the spread over here, which is where we have 80, 150, 10 and below. So we have a difference there, and that is the spread. Now with online forex brokers, the purchase price is always higher than the sales price. The purchase price is always higher than the sales price. So we are purchasing at this price and the brokers are selling at this price. Now what this means is this: if you look at this properly, you see that this is a purchase price. It is much higher. We have for Euro US if you can look properly, USD JPY, you see that the purchase price, which is the ask price, is 105.972, while the sales price is 105.964. Now, this is it. For example, you are buying a phone and the phone is worth 50,000 naira. 50,000 naira. This is a purchase price. Now, if you are to sell that phone back at the market, the broker is selling you. If you want to sell this phone in the market, this phone is worth 40,000 naira. That is how much you can sell your phone, that particular phone you are buying in the market. But if you want to buy that phone, if you are coming that you want to buy, we are going to sell for you for 50,000 naira. So the broker is not telling you that if you are coming to sell that same phone to us in the same value, we're going to give it to you at 40,000 naira. We're going to buy it from you at 40,000 naira. So that is what it means by purchase price and ask the sales price. So purchase price, which is the ask price, okay, and the sales price, which is the bid price. So what this does most of the times is that whenever you're going into the market, anytime you enter the market, let's say you just come into the market and then you open a buy trade and you close that buy trade instantly, maybe on USD/JPY, what will happen is that you're going to see a loss on your account instantly. You're going to experience a loss on your account instantly. Why is it? Because you did not wait for the value of that currency to increase before you sell. For example, you just came to the market and bought your phone for 50,000 naira. 50,000 naira. Now, and you say, no, I don't need this phone anymore. I want to sell this phone back. If you are selling back to the brokers, you are selling at 40,000 naira. How much will the broker give to you back? They're going to give you 40,000 naira, and you went to the market with 50,000 naira. It means you've lost 10,000 naira. So for you to sell back that phone, you have to wait for that phone that you purchased at 50,000 naira for the value of the phone to increase. If the value of that phone now increased to 80,000 naira, the broker is now selling this phone for 80,000 naira to people, and then you say, I want to sell this phone. The broker will buy it from you at 10,000 naira. Remember, the purchase price is always higher than the sales price. So if the broker still buy your phone for 70,000 naira, you are still going to be on profit of 20,000 naira, simply because you waited for the value of the phone you purchased to increase. You make 20,000 naira profit. That is what is happening in the forex market. So if you open a trade, you need the market to move in your favor in an amount that is equivalent to the spread before you can start to make potential profits. So to close any trade, you have to wait for that for the value to increase. Now sometimes these brokers, this is where they make their money. Most brokers, they make their money in spread. Take note, it's because of the spread. That is why the broker is making 10,000 naira profit from that your phone. It's because of the spread, the bid price and the ask price. So this is one of the major ways that forex brokers make their money. They also make their money from other ways, from commissions, from swap fees and others. So that is how forex is. Now, what is lots when it comes to forex? Lots. Forex is commonly traded in a specific amount called lots. You want to buy gold. How much gold do you want to buy? What's the quantity of gold do you want to buy? I want to buy one standard lot. When you say I want to buy one standard lot of gold, it means you're buying 100,000 units of gold. 100,000 units of gold. That is because a standard lot in forex is equals to 100,000 units. 100,000 units. So lot is the number of currency pair you are about to buy or you are about to sell. So if you come now and say I want to buy gold, and then you buy gold, you buy one lot of gold. And if let's say the price of gold was at 1.9195, and then as you buy gold, one lot of gold, and the price of gold just increased from 19195 to 19196 6. So what you do now, you calculate the pips. How many pip difference is this? Remember the fourth value after the decimal points. The fourth value 1 2 3 4 5. 1 2 3 4 3 4. We have 6 here. 5 minus 6 1 pip. So for 1 pip movement of gold just change in price, it increased in price in just 1 pip, and you bought one lot, you have made $10 instantly. $10. So if gold move, the price of gold move from 195 to increase 10 pips, what you should be making is $100 of gold. $100 instantly, just by buying gold one lot, and the price change in just 10 pips. You understand the point? That is it. So guys, when we talk about lots, we have different type of lots. We have the standard lot, which is represented as 1.0, which is one lot. We also have the mini lot. The mini lot is 0.10. We also have the micro lot. The micro lot is 0.001. And then we have what is called the nano lot, and the nano lot is 0.001. So each of them represents, for instance, this one represents 100 units of the currency pair you are purchasing. So if you are going for micro lot, which is 0.01, 0.1, you are purchasing 1,000 units of the currency pair. If you are going for a mini lot, which is 0.1, you are purchasing 10,000 units. 10,000 units. And if you are going for one lot, one standard lot, it means you are purchasing 100,000 units of that currency pair. So I'm going to in the future training, we're going to see how to calculate your profits when you have pips. And let's say you purchase not one lot this time, you purchase a mini lot, and the trade move 20 pips, 50 pips, how to know how much you're going to make or how much you're going to lose if it's going against you. So that is lots. So this is it, standard lot size for 100,000 units. There's also a mini lot for 10,000 units, micro lot for 1,000 units, and nano lot size, which is 100 units of currency. Now, what is margin? Margin is the money that is retained in your trading account when you open a trade. So when you're taking any trade, there should be a certain amount of money that will be kept aside as security for that trade you're taking. However, because as average retail traders, people like you and I sometimes would lack the necessary margin to trade a high volume that will be able to get good profit from the markets. What this forex broker does is that they give us what's called leverage, so that with that leverage we can be able to make a lot of profit. That moves us to leverage. Now, leverage is a capital that the forex broker provided to the forex trader, and this leverage will increase the volume of trade that the trader is making. Yes, so for example, let's say you want to buy Euro USD. You want to buy Euro USD. Now, what's the unit of Euro USD you want to buy? You want to buy 100,000 units of Euro USD. Now, if this one that you've purchased 100,000 units of Euro USD, or even if it's gold, 100,000 units of gold. Now, if this currency pair should move 1 pip, what you have made is 100,000 euros. That is the usual. That is what you have made, 100,000 euros. But with leverage usually comes with 1 to 10. Now, if you are using 1 to 10 leverage, and then you're using 1 to 10 leverage, and you have 1,000 euros in your trading accounts, 1,000 euros in your trading accounts, and you can trade a currency pair with 10,000 position size. Let's say what we're doing right now is coming. Let's take what's up. So whatever money you are making, let's say you come in with 1 to 10 leverage size, and then you are trading euros. Now whatever money you're going to be making, instead of you making just this your 100,000 euros, the broker will multiply your profit times 10 for you. So you have to be very careful, because this multiplication by 10 is not only when you are profitable. So if you are going on a losing trade, the broker will also multiply your loss times 10 for you. So the same applies if you are going with leverage of 1 to 100. So you have to be very careful which leverage you're going to be using. And when you're using your leverage, you also have to be careful the lot size that you are using to trade. Whether one lot size, you're using mini lots, you're using micro lots, or you're using nano lots. So you have to be very careful. These concepts is what every forex trader, beginner forex trader, should be able to understand before they open their trading account, and before they start trading with whatever lot size they want to be trading with. Now, for example, let us make this clear for us. Now, let's say leverage, what it simply means in a nutshell is that it allows you as a trader to trade large volume just by having small deposits. So your gain will be magnified by the broker based on the leverage size, or your losses will also be magnified based on the leverage size. So if, let's say, you have $1,000 in your account, and then you're using 1 to 10 leverage, and then you have a profit of 5%, which is your asset grows by 5%. Now, what will happen is you're going to make $500. But on the other end, if you're not using a leverage, if you are still using a $1,000 account and you're not using a leverage, that your 5% will be $50. But because you're using 1 to 10 leverage, that $50 will be multiplied by 10, and that will give you $500. The same happens when you are losing. So if you are losing before, without leverage, you should be losing just $50. But if you are using leverage 1 to 10, and then you are losing, you should be losing $500. That is why you have to be careful about the leverage that you are using. So the same applies when you're using a leverage of 1 to 50. So whatever you're doing, making is multiplied by 50. The same applies when you're using 1 to 500 leverage. So you want to be very careful about the leverage you use. Now let's talk about the price and quotes. So when you trade forex, you see ask and bid price. Now one thing that you should keep in mind is that when you want to learn forex from the scratch, you can either be buying or you can be selling any currency pair of your choice based on your speculation. Now, what is the ask price? The ask price, which is this price, is the price at which you can buy a currency pair. Remember, I will say this ask price is a price that is usually higher. It is price that is usually higher. This is the ask price, the purchase price. That is the amount you are buying. Then the bid is the price at which you can sell a currency pair. So this is the sales price. It is usually lower than the ask price. You understand the point? So that is the currency price and quotes. Now, when we talk about stop loss and take profit, I'm just going to give us an overview of what it means. It simply means you as a trader telling the broker when to close a trade, either on profit or on loss for you. So a stop loss is assigned to let the broker to know when you are willing or how much risk you are willing to take on your accounts, or how much profit you are willing to take before they should close you out of the market. That is take profit and stop loss. When it talks about take profits, let's say for example this is where price is at this point, price at this point, and then we are going into the market at this point, and then we'll buy. We'll say we'll buy. So what will happen is, price is still at this point, and then we can take this order, this line, this price, and set that price as our take profit. What it simply means is that if the price starts going up, goes up, even comes down, the trade should still be on. The trade should be on. But if the price hits that line, this line, please, the broker, even if I'm not on my phone, even if I'm in my business, if I'm in my job place, broker, please close this trade for me and put this profit, drop this profit on my account. That could be $100 profit in your account. So even if you are busy, the trade will close for you on profits. That is what the take profits actually and really means. Now, when it comes to the chart, this is how you're going to see it. This is your buying point, and this is your take profit point. Take profit is usually known, usually called TP, take profit. Then when it comes to stop loss, we usually call it SL, which is stop loss. So the stop loss, what it means is that you are telling the broker that if the price of whatever I'm buying, or the trade is going wrong for me, please, broker, close the trade on loss for me. For example, if you look at your screen now, you see that you buy at this point. This is the point where you buy. Okay, now this is your buying point, and then you see this is the first time you take the trade, and the trade went on profit for you. Maybe it makes you $10 profits, and then all of a sudden you've not closed the trade, the price start coming down. When you get to this point back, your buying point, it will be $0 for you, and then it comes down, it will be, let's say you are now on minus, on loss, let's say $5 loss, and then it comes back up again, as we can see, to the buying point, and then it's still on $0, no loss, no profit, and then it's not falling down, already you have set a stop loss that if price reach that value, broker, even if I'm not with my phone, broker, please close that trade on that loss. maybe that should be $10 loss. I do not want to experience more than $10 loss. So when the price just hit that point, automatically it closes for you on that loss. So you're telling the broker that, broker, what I'm willing to take is $10 loss. If it's above $10 loss, close the trade for me. So that is what our stop loss actually work. So guys, this is where we're going to end the training. We're going to continue later with part 3 of this training. But before then, let's take a look at a practical aspect of what we have been discussing. Let's go over to our MT5 and see the practical aspect of all of this.